Hi there. What if I told you that there is $1 million trading strategy that actually converted a mathematician into a very successful trader? He eventually became a legend in the trading industry with a net worth of $28 billion. Yes, and his name is Jim Simons. And he runs a hedge fund. And the name of the hedge fund is Renaissance Technologies LLC. And the name of the fund, which uses a very specific trading strategy, is called as the Medallion Fund. And it uses many trading strategies. But along with that, there's a specific trading strategy which is called as the mean reversion trading strategy. And it's an amazing trading strategy, and that's what we will be discussing. So here we have come across two new words. What are those new words? Hedge funds and mean reversion trading strategy. So in this video, we are going to discuss about what is a hedge fund and what is mean reversion trading strategy. But before I go ahead, I just want to welcome you all to this video and let you know that Professor Joe, the mentor, is very soon going to become Dr. Wealth. I thought I'll just keep you posted with my plans and the YouTube channel. So to explain what is hedge funds, let me compare it with mutual funds. I'm sure everybody know what a mutual fund is. Mutual fund is nothing but a pool of money put in by investors and managed professionally by professional fund managers. So let us understand the difference between a hedge fund and a mutual fund. Now, hedge fund is basically for very wealthy people. You call it the HNI, high net worth individuals. People who can invest more than 10 crore rupees. And mutual funds are for those people who want to start their investment from 500 rupees. So you can see there's a vast difference between the kind of portfolio that we are looking at in hedge funds and mutual funds. The regulations for the hedge fund is very less compared to the regulations on the mutual fund industry. Mutual fund is very highly regulated by the regulators of the stock markets. In India, it is SEBI. Hedge funds are allowed to invest in stocks, bonds, debentures, but other than that, hedge funds are also allowed to take positions in derivatives, futures and options. They can also invest into penny stocks. They can also invest into real estate. So in hedge funds, the fund managers can invest the money wherever they think that they can earn returns from. Whereas in mutual funds, you have to invest only in the regulated market like stocks, bonds, or balanced financial instruments. They are not allowed to invest into high risk investments. The hedge fund managers charge management fee about 1.5% to 2%, and also above that they charge approximately up to 20% as performance fee. Why? Because hedge fund is purely based on profitability. The only goal is to make huge profits from the markets. So the managers have a performance fee. Whereas in mutual funds, there is only a management fee somewhere between 0.5% to 1.5%. The biggest difference in hedge funds and mutual fund is the hedge funds are allowed to take positions in the sell side also, whereas mutual funds are not allowed to take position in the sell side. I'm sure you must be thinking why hedge funds are called as hedge funds. Because of the freedom the hedge fund managers has, that they can buy in a lot of financial instruments and they could hedge those instruments by selling in derivatives like options or futures. So they can hedge their buying positions. That is why hedge funds are known as hedge funds, because they're allowed to hedge their positions. Now in this hedge fund industry, there are a lot of strategies that the traders or the fund managers use. But one of the most unique strategy, I can call it a $1 billion trading strategy. It's called the mean reversion trading strategy. So what is a mean reversion trading strategy? It's a very interesting trading strategy. So what happens is, whenever the price go up, that is when the price go bullish, it comes down. And whenever the price goes down, that is bearish, it then comes back up. So basically in the markets, you will see the price going up and down. So the middle price, the average price of the price movement is called as the mean. And when you connect these dots of different average prices, you get a mean line. The mean line can look something like this. Like you can see in this simulation, the price moves up, reaches an overextended level, and then comes back down towards the mean line, and then goes down to the overextended level, and then comes back again to the mean price. So what this tells you is when the price moves away from the mean, it's an opportunity for a trader to enter into the trade so that they can wait for the price to come close to the mean again. So this is what is called as mean reversion. Now the mean reversion can be traded in two ways. One is in the direction of the trend, which you can see something like this. Here we have taken a crossover of EMA 10 and EMA 20. And the cloud that you see, which is in light blue color, is basically the mean of the price. As the price keeps going up, the cloud is also moving in the upward direction. And you can see that the price reverses back and comes back to the mean. Whether it is a bullish trade or whether it is a bearish trade, you will always see that the price is coming back to the mean. So when you want to trade in the direction of the trend using the mean reversion trading strategy, every time the price reaches the cloud and you see a good candlestick pattern, you enter into a trade with a 1:2 risk to reward. The mean reversion trading strategy can also be used against the trend. So like you can see over here, there is a chart. On the top of the chart, you can see a resistance zone. And over here, you can see a support zone. So let us first study the resistance zone. This is a trade which you would want to take against the trend. Here you see that the trend is in the upward direction. The price reaches the resistance like you can see over here, and then the price retraces back towards the mean. So if you want to enter a sell position over here, as the price leaves and comes down away from the resistance zone, you can enter into a sell with your target very, very close to the mean. On the other hand, if you want to go with a buy, you can see when the price reaches the support zone, the price is in the sell direction. It's a bearish movement. You can see the moving averages is coming downwards. But because the price has reached a support zone, you can enter into a buy trade after watching a good positive candlestick pattern, and then the price reaches back again till the mean. So, in the mean reversion trading strategy, you can take both positions. One is with the trend and the second is against the trend. Now, out of my personal experience, if you ask me what is better, I will say that trading in the direction of the trend using the mean reversion trading strategy is one of the best trading strategy. So when the price reaches the zone, or you can call it as a dynamic support and resistance zone, you go for a buy if it is in an upward direction, and you go for a sell if it is in a downward direction. Now understand one thing, that just by looking at this one example, you are not going to learn the entire mean reversion trading strategy. You will have to practice it. So to practice, the rule is very, very simple. You can pick up a time frame which is convenient for you. That means if you have a lot of time, then you go with a 5-minute or a 15-minute chart. But if you have less time, then go with a daily chart. You wait for the crossover to happen in whichever direction, say a bullish or a bearish direction. Let the price go away from the mean and let it come back again to test the mean. And when you see that happening, if it is a bullish price movement, you go for a buy. And if it's a bearish price movement, you go for a sell. So simple. The most simplest trading strategy. So friends, if you want to try this trading strategy, do a paper trading for 100 trades. Once you are satisfied and convinced, then only start infusing your own money. Because trading is not just learning. Trading is practicing. If you practice with patience and discipline, you will be able to become a successful trader. And before you enter into the market with real money, make sure that you follow the risk management. When you are trading, do not infuse more than 0.5% of your equity in any single trade. And as you become a professional trader after a few years, then you can gradually increase your equity. Till then, keep practicing. So friends, I hope that this simple explanation is very, very clear to you. And if you like the way that I have explained, kindly like this video. And if you think that this little explanation can be helpful to some of your friends, kindly share this video so they can learn something out of this video. And if you want to leave a comment, you're more than free to drop a comment. I do read your comments, and if I think it is needed, I do reply also. And friends, if you're still not subscribed to the channel, kindly subscribe to the channel and click on that bell icon. Because every time I see a new subscriber, it motivates me to create more such videos for you. Well, that's all in this video, but before I sign out, I want to tell the golden words one more time. Keep learning, keep growing, keep getting better every single day. Thank you. Namaskar.